Look, when you hear that the Internal Revenue Service released new 2026 tax brackets, you do not need to panic. You need clarity. Headlines are built to grab attention, not to explain the full picture. For many retirees, these updates are modest inflation adjustments, not hidden tax increases. For others, the interaction between retirement withdrawals, investment income, and Social Security taxation may require careful planning. That is where awareness matters. The power is not in memorizing percentages or studying complicated charts. The power is in understanding how your income moves through the system and how timing decisions can affect outcomes. When it feels complex, pause and seek qualified advice instead of reacting emotionally. My name is Judith Carver. I am a senior protection educator, not a lawyer, and this video is for educational purposes only because laws vary by state and individual circumstances. I am here to help Americans over 60 understand financial and legal changes in plain language so you can avoid confusion, protect what you have built, and remember that your rights do not expire with age. Here's the thing. Every year, the Internal Revenue Service adjusts federal income tax brackets for inflation. That means the percentage rates often stay the same, but the income ranges attached to those rates move slightly higher. This is designed to prevent what is called bracket creep, where inflation alone pushes you into a higher tax bracket, even if your purchasing power did not really increase. Most people never notice this. They just hear new brackets and assume something dramatic happened. Now listen carefully. For retirees, what matters is not just the bracket percentages. It is how your total income fits into those updated ranges. This is where it gets interesting. Many seniors believe that if they are in a lower bracket, none of their Social Security can be taxed. That is not exactly how it works. Social Security taxation is based on what is called combined income. That includes your adjusted gross income, any non-taxable interest, and half of your Social Security benefits. Depending on that combined income, up to 85% of your benefits can become taxable. That does not mean 85% is taken. It means up to that portion may be included in taxable income. This is the part nobody explains clearly. The brackets determine the rate applied after the taxable portion is calculated. Let me show you exactly what happened in a typical situation. Imagine Robert, age 72. He receives Social Security, a small pension, and takes required minimum distributions from a traditional retirement account. The new 2026 brackets shift upward slightly due to inflation. On paper, that sounds like relief. But here's where it gets crazy. His required minimum distribution increases because his account balance grew the previous year. That additional withdrawal raises his combined income. Suddenly, more of his Social Security becomes taxable, and part of his income edges into a higher bracket. Robert did not see this coming. He thought the new brackets would automatically mean lower taxes. The brutal truth is this: brackets alone do not tell the whole story. Stay with me. Required minimum distributions are a major driver for retirees. Once you reach the mandatory age, you must withdraw a calculated amount each year from certain retirement accounts. That withdrawal counts as ordinary income. It can increase your taxable income, affect how much of your Social Security is taxed, and even influence your Medicare premiums through income-related adjustments. Most people never connect these pieces. They look at the bracket chart and stop there. Now pause for a moment. Think about your own income sources: Social Security, pension, annuity, dividends, interest, part-time work, retirement withdrawals. The Internal Revenue Service does not look at them separately. They stack together. The new brackets simply determine which percentage applies to each layer of taxable income. Watch out for this. Crossing into a higher bracket does not mean all your income is taxed at that higher rate. Only the portion above the threshold is taxed at the higher percentage. This misunderstanding causes unnecessary fear every year. Here is the untold truth. For many retirees living primarily on Social Security with modest additional income, annual bracket adjustments are relatively small. Inflation adjustments often widen the bracket slightly, which can mean a small reduction in taxes compared to what would have happened without adjustment. But for retirees with higher distributions or investment income, the interaction between brackets, Social Security taxation, and Medicare premium thresholds can create a noticeable change. Let me tell you about Susan. She is 68, recently retired, and drawing from her traditional retirement account to supplement Social Security. She hears about the new 2026 brackets and assumes she is safe because her taxable income falls within a middle bracket. Then she sells a portion of mutual funds to pay for home repairs. That capital gain adds to her income for the year. Here is where it gets interesting. That additional income pushes more of her Social Security into the taxable category and nudges her closer to a higher Medicare premium tier. Susan did not do anything reckless. She simply did not see how interconnected these systems are. This is important. The standard deduction also adjusts for inflation. Seniors over 65 receive a higher standard deduction than younger taxpayers. When the deduction increases, it reduces taxable income before brackets are applied. For some retirees, that larger deduction offsets modest increases in income. But do not let that lull you into ignoring planning. Even small differences in income timing can matter. Most people never notice this pattern. The real leverage for retirees is not the bracket chart itself. It is timing and coordination. For example, you might choose to take slightly larger withdrawals in a lower income year to avoid stacking too much income into a single year later. You might consider how charitable giving strategies interact with taxable income. These are planning discussions to have with a qualified professional. I am not giving you legal or tax advice. I am showing you where the pressure points are. Now listen carefully. There is also ongoing discussion in Washington about future changes to tax rates scheduled to expire in coming years unless Congress acts. That creates uncertainty. But as of the current 2026 bracket release, the structure remains similar, with inflation adjustments applied. Do not let headlines convince you that a secret increase has quietly taken place. Always verify through official Internal Revenue Service publications or a trusted tax professional. This is where seniors feel overwhelmed. The language is technical. The charts look intimidating, and every news cycle makes it sound urgent. But here is your reality check. You do not need to memorize the bracket tables. You need to understand how your income flows through the system. What pushes it higher? What keeps it stable, what decisions you control. The mental checklist I want you to carry is simple. First, estimate your total income for the year, including withdrawals and potential asset sales. Second, understand how that total income may affect the taxable portion of your Social Security. Third, remember that only the income within each bracket slice is taxed at that rate. Fourth, consider how income levels may influence Medicare premiums. Fifth, consult a licensed professional before making large withdrawals or sales if you are uncertain. Do not let them fool you with dramatic headlines. Tax brackets adjust every year. What matters is how your individual income picture fits within those updated ranges. The calm approach is stronger than the reactive one. Look, when you hear that the Internal Revenue Service released new 2026 tax brackets, you do not need to panic. You need clarity. Headlines are designed to grab attention, not to explain nuance. For many retirees, these updates are modest inflation adjustments meant to keep pace with rising costs. They are not secret tax increases hiding in the fine print. For some retirees, however, the interaction between retirement withdrawals, investment income, and Social Security taxation does require careful planning. That is where awareness becomes valuable. The power is not in memorizing percentages or studying complicated charts late at night. The power is in understanding how your income flows through the system and how timing decisions can affect outcomes. When choices feel complex, that is your signal to pause and seek qualified advice, not to react emotionally. And if this helps you, please like and subscribe so I can continue clarifying topics that feel confusing or unclear. If a situation ever feels legally or financially complicated, slow down and reach out to a licensed attorney or qualified tax professional who can review your personal details carefully. A short conversation with the right professional can prevent months of stress, second guessing, and costly mistakes. You work too hard for your retirement to make decisions based on headlines or assumptions. Personalized advice matters because your income sources, filing status, health coverage, and long-term goals are unique to you. You deserve calm, clarity, and respect when discussing your finances. No one should make you feel rushed, embarrassed, or uninformed. Ask questions, request explanations in plain language. Take notes, bring documents. You are not being difficult. You are being responsible. And please share this information with friends, neighbors, or family members who may be confused by the same headlines. Many seniors feel anxious not because the situation is catastrophic, but because no one explained it clearly. A simple conversation at the kitchen table can ease fear and prevent misinformation from spreading. And remember, your rights do not expire with age.